This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and adjunct professor of accounting and financial management. For this lecture, we will use the excellent text by Brigham and Davis, Intermediate Financial Management. Today we will cover Basic Stock Valuation, Part 2. We will now look at an expansion plan for our company to demonstrate the non-constant growth model, again using free cash flows. The finance expansion will be financed by its owners. The projected free cash flows are as shown. In year one, they will have to inject money into the company of $10 million, followed by a positive free cash flow of $20 million in year two, $35 million in year three, and after that, the free cash flows will grow at a constant rate of 5%. There is no change in WACC. The number of marketable securities are their value. There's no change in debt, preferred stock, or the number of shares in stock outstanding. How do we estimate the value of operations? Well, the free cash flows are forecast for 3 years in this example, so the forecast horizon is 3 years. The growth in free cash flows is not constant during that time period, so we can't use the constant growth stock model until after year 3. What we will do is look at this timeline of the free cash flows, negative 10 again in year 1, positive 20 in year 2, 35 in year 3, and then after that the cash flows grow constant, so free cash flow year 3 times 1 plus the constant growth rate gives us the cash flows in year 4. In year 5 we take the free cash flow in year 4 times 1 plus the constant growth rate, etc., etc. So after year 3 we can use the constant growth stock model, and we can use that to calculate the so-called horizon value, or terminal value. The horizon value, or the value of operations at time t, in general can be calculated as the free cash flow at time t times 1 plus the growth rate over the WACC minus the growth rate, as long as that growth rate is constant. So we will use this to get the value of the company in year 3. In our example, the free cash flow in year 3 is $35 million, the WACC is 11%, and the constant growth rate after year 3 is 5%, so the horizon value, or the value of the operations in year 3, will be 35 times 1.05 over 0.11 minus 0.05. This equals $612.5 million in year 3. We can now do a more general table of our cash flows. And what we were going to use, again, is the cash flow in year 1, year 2, and year 3, shown up here at the top. Plus, in year 3, we have the horizon value. And we will discount all of these back to year 0 to get the present value of the first 3 uneven cash flows here in year 0, plus the present value of the horizon value in year 0, and that will equal the value of operations at time 0, or today. If we write this out mathematically, we see that we have a cash flow in year 1 of negative 10, in year 2 of 20, in year 3 of 35, and if we were to sell our company right after receiving that cash flow of 35, the value of operations in year 3 would be $612.5 million. We now discount all of these values back to year 0, so minus 10 divided by 1 plus WACC, which is 1.11, gives us minus 9.009. 20 divided by 1.11 squared gives us 16.232. And 35 divided by 1.11 cubed gives us 25.592. Our terminal value of 612.5 million divided by 1.11 cubed gives us 447.588. Summing all of these up, we get the value of operations today of $480.67 million. To figure out the estimated intrinsic stock price, we take the value of operations of 480 plus short-term investments of 100, giving us a total value of 580.67, minus the 200 million in debt, minus the 50 million in preferred stock, gives us a value of equity of $330.67 million. There are 10 million shares outstanding, so the intrinsic stock price is $33.07. An interesting question to ask related to the volatility of stocks is how much of the value of operations is based on cash flows long term, or in our example, from year 4 and beyond. We showed that the horizon value is the value of all free cash flows from year 4 and beyond discounted back to year 3. Well, the present value of that horizon value is the present value of all free cash flows from year 4 and beyond today. If we were to take the present value of the horizon value divided by the value of operations, that is the present percent of total value due to long-term cash flows. Calculating this mathematically, we have the value of operations and the present value of horizon value. We showed that the value of total operations is $480.67 million. We showed earlier the horizon value was $612.5 million. Well, our WACC is 11%, so the present value of the horizon value is 612.5 divided by 1.11 cubed, or 447.588. And if we take this divided by this, we see that the percent due to long-term cash flows of the value of operations is 93%, a very large fraction of the value of the company. For an average company, this percent is around 80%, and this shows why stocks are so volatile, as the estimates that go into this calculation regularly change, and that affects the value of a company today. To show further examples of that, we will look at forecasting free cash flows, a simple approach. We're going to forecast sales to grow at chosen growth rates and see how this affects the value of the company. Then we will forecast net operating profit after taxes, NOPAT, and total net operating capital, OPCAP, as a percentage of sales. For our hypothetical company in millions of dollars, the most recent data indicates that sales is 2,000 million or $2 billion. Total net operating capital is $1.12 billion, and we will assume operating profitability ratio, or NOPAT over sales, of 4.5%, and the capital requirements ratio, the capital required in operating capital to support those sales, as 56%. We want our WACC to get lower. The target weighted average cost of capital we want to get down to 9%. So our initial operating assumptions for the no change scenario, meaning operating ratios remain unchanged from values in most recent years. We will say sales are growing okay now, but they're going to shrink. Sales will grow at 10% the next year, 8% the year after that, and then 5% and 5% forever. The long-term growth rate is 5%. The target weighted average cost of capital, again, is 9%. So If we look at a table with our assumptions, we have WACC of 9, sales of 2 billion, operating capital of 1.12 billion, sales growth rate going in year 1 to 10, down to 8, down to 5, and 5. Our NOPAT over sales stays at 4.5% forever, and our operating capital over sales stays at 56% forever. So let's look at an example. In year 1, sales will go up. So 2,000 times 1.1 gives us sales of $2.2 billion. NOPAT is the $2.2 billion times 0.045, are in millions, $99 million. Our operating capital required to support those sales is 2.2 times, or $2,200 million times 0.56, R&R units 1.232. We know that free cash flow is net operating profit minus the change in operating capital, and ROIC is NOPAT over operating capital. So if we have no changes in operating ratios, we see sales go up again year after year like this. Our NOPAT is going to go from 99 to 107 to 112 to 117.872. And again, NOPAT, if we go back up here, is calculated by 4.5% of sales. So NOPAT here, we get from 0.045 times 2,200. Here it's 0.045 times 2,376. Here 0.025 times this, and here 0.025 times that. Operating capital is 56% of sales, so 2,000 times 0.56 gives 1,120. 56% of 2,200 gives us 1,232. 56% of this gives this. 56% of this gives this. 56% of this gives that, etc. Free cash flow is going to be NOPAT minus the change in operating capital. So the minus 13 is $99 minus the change in these two. So 1,232 minus 1,120 is $112. And if we take 99 minus 112, we get minus 13. Similarly, the 8.36 comes from this number, NOPAT, minus the change in these are 107 minus, in parentheses, 1,331 minus 1,232. Gives us 8.36. And this number again comes from NOPAT minus the change in these, and this number from NOPAT of 117 minus the change in these. So now we have our free cash flows. To get the growth in free cash flows, well, you get final minus initial divided by initial, or this minus this divided by this gives us negative 164%. And this number comes from this minus this divided by this, etc. So free cash flow is growing at these rates in each year. ROIC we are assumed as staying at 8%. So this isn't good. So ROIC is our rate of return on invested capital of 8%. We are borrowing at WACC at 9%. So we are borrowing at 9, investing at 8. We are losing money. That's not a good thing. The intrinsic value of our company we can calculate as we did in the past. So the horizon value is now on year 4. That's going to be free cash flow year 4 times 1 plus the constant growth rate. over WACC minus the growth rate. What's our free cash flow in year 4? We go back here, free cash flow in year 4 is 48.025. So we have 48.025 times 1 plus our constant growth rate, our 1.05, over WACC minus that constant growth rate, our 9% minus 5%, and we end up with $1,260.65. The present value today of that horizon value will be this number, 1,260.65 over 1 plus WACC of 9% to the fourth, are 893.08. The present value of the free cash flows before the horizon value is minus 13, 8.36, 45.738, and 48.025, each divided by 1 plus WACC to the power in which the year those cash flows take place, are minus 13 over 1.09 to the first, 8.36 over 1.09 squared, 45.738 over 1.09 cubed, plus 48.025 over 1.09 to the fourth. So the present value of the free cash flows is 64.45. We add the present value of the horizon value in year 4 of 893.08, and we get the total value of operations. So the value of operations is the 893 plus the 64 are $958. So if we look at the value of operations versus the total net operating capital, since ROIC is 8 is too low compared to 9, the capital is not earning enough to meet investors' required return, so the horizon value is less than the total net operating capital at the horizon. The current value of operations is less than the current total net operating capital, meaning the company is losing money over the next few years. So ROIC must be greater than WACC over 1 plus the growth rate for the horizon value to be greater than the value of operations at the horizon. How can the managers of a money-losing company possibly improve the situation? Well, we can look at the possible value drivers that they can change. So the value drivers are the inputs to the free cash flow valuation model that managers are able to influence. Sales growth rates, they can promote and sell more of their product. Operating profitability, they can cut their costs and hopefully improve that. Capital requirements, they could tighten up their capital requirements, perhaps have to have less operating capital, which could improve profitability, and they can negotiate with banks and maybe get better deals on selling more stock to reduce their cost of capital. We will start with the example of, let's say, they do a lot of advertising in this example and improve their sales growth rate. So we started out with a sales growth rate in year 1 of 10%. Let's say we can get that up to 11, in year 2 from 8 to 9, and in year 3 and beyond from 5 to 6. If the OP stays still at 4.5% and CR at 56% and ROIC at 8, does this help? And the answer is no. The value of operations goes down from 958 to 933. The rate of return of operated invested capital, ROIC, must be greater than WACC over 1 plus WACC for growth to add value. In this case, again, ROIC is 8, WACC is 9. We're borrowing at 9, investing at 8. The more stuff we sell, the more money we lose. How about the impact of higher operating profitability, increasing efficiency? So our growth rates here now stay the same, but operating profitability goes up very small from 4.5% to 5.5%. Well, then ROIC has increased from 8 to 9.8%, and our value of operations has now gone from 958 to 1,523. Things have improved because ROIC is now greater than WACC. How about the impact of lower capital requirements? Getting people to pay their bills quicker, not having to have as much of our capital locked up in current operations. Well, if we can get the CR from 56% down to 51%, again, ROIC goes up now from 8 to 8.8%, and the value of operations goes up from 958 to 1,191. Again, we have ROIC at 8.8, WACC at 9. It's still not good, but it's not as bad as it was. So lower capital requirements increase the ROIC of 8.8 greater than 8.26. The ROIC causes an increase in the value of operations. If we can do both of these at the same time, impact of simultaneous improvements in OP and CR, again, operating profit going from 4.5% to 5.5%, and capital requirements going down from 56 to 51, then we get a ROIC of 10.8, which is well above WACC of 9, and our operating profit, our value of operations, goes from 958 to 1,756. So our impact, if we do growth now and go up to the previous growth rate, well, now growth will help us when earlier it hurt us, because we are now making money on each sale. So we go back and now have our growth rates from 10 to 11, 8 to 9, 5 to 6, our operating profit from 4.5 to 5.5, and our capital requirement ratio going down from 56 to 51. ROIC goes all the way up to 10.8%, well above the 9% WACC, and our value of operations increase from 958 to 2008. So when ROIC is low, increasing growth reduces value. When growth is low, increasing ROIC adds value. When ROIC is high enough, increasing growth adds enormous value. Here we have the different ROICs. We have growth from 5 to 6, and in this example, the value of the company went down, but if we go up here, the value of the company goes up. Are volatile stock prices consistent with rational pricing? The answer is absolutely, because the future is unknown. The previous slide shows that small changes in ROIC and growth cause large changes in the value of a company. Similarly, small changes in the cost of capital, perhaps due to changes in risk or interest rates, cause large changes in value. As new information arrives, investors continually update their estimates of operating profitability, capital requirements, growth, risk, and interest rates. So if stock prices weren't volatile, then there isn't a good flow of information. This is why the stock market responds so much to changes in the Federal Reserve, perhaps changing the interest rates that we will all pay, also perhaps changing the inflation rate in the economy. It's going to respond a lot to whether or not we think we are in growth or in a recession, and then to individual things like how many NVIDIA chips do we think will be sold in the future. And this will make a company like NVIDIA extremely volatile. I thank you for watching this video, and we will cover the rest of the chapter on stock valuation in Lecture 3.